Okay, hello everyone. This is Vivek Krishnamoorthy from QuantInsti. I head the content and research team here. So welcome to the first webinar of the QuantInsti 10-year anniversary series. So today's topic is what really impacts a quant strategy. And we have a pretty illustrious panel today with us. So I have three guests today here with me here. I have Radovan, Nicholas, and Laurent. So I'm going to give you guys a short intro about each of them, and then we'll get started on the actual discussion of the day. Right? Nicholas is actually the founder and CEO of Factor Research. He's worked at quite a few financial institutions before: Jackdaw Capital, GIC, that's the Government of Singapore Investment Corporation. He's worked with the Citigroup in multiple locations. And he's very much part of what I would call the quant finance tribe. So Nicholas maybe can talk a little bit about himself when he is talking about strategy and stuff. Then let me come to Laurent. Now Laurent is having some camera trouble, so you're only going to be hearing him. I don't think you'll be able to see him. Nevertheless, he is online from Tokyo. So he has worked with Japanese equities for a pretty large part of his career, where his mandate was primarily being a short seller to perform in a market which has been very bearish for very, very long. And his expertise, I believe, is really speaking in the space of short selling as well as in the alternative space using systematic trading. And the third person I want to talk about is Radovan, who is the CEO and head of research at Quantpedia. It's one of my favorite portals. So I kind of have a fanboy moment here while I meet Radovan. Now, he is a former quant portfolio manager, and he's managed several million euros worth of funds in the past. Now, these funds were focused on different types of strategies. I guess he can talk about it again when we come to him, right? So as far as that's as far as the introductions go, so let me start with you, Nick, for the time being. So the thing is, we're all trying to find these alpha-seeking strategies, and that's really what this whole field is about. So I'm going to ask you like a really wide open question, and where do you think we should actually start looking for alpha strategies?
I'm going to take a little bit the contrary position and going to argue that 99% of investors should not look for alpha-seeking positions, simply because all evidence points against it. I mean, this is a quant panel, right? So let's focus on data, right, and look at the data that's out there. So we can look at mutual funds, have been around for like multiple decades. We can look at S&P SPIVA scorecards, which effectively show that creating alpha for mutual funds is incredibly tough. Most underperform the benchmark over 5 years, 10 years, 15 years. Doesn't matter if you look at cross-sector, inter-sector, and specialists, whatever. Then you can look at the hedge funds, right, which are even more incentivized to generate profits. And if you want to pull up the one slide I put together on two hedge fund indices, it's actually the same kind of index, which is just nice for visualizing the alpha generation. One is exactly. So one index is from Credit Suisse, and the other one is from HFX. Both effectively show the performance of equity market neutral hedge funds. And you can see that from 2008 to 2019. So we have, like roughly, well, more than 10 years, right? And what you can see is something that looks like a pancake that isn't really moving much. And I used to run a hedge fund, focus on equity market neutral strategies. So I'm quite familiar with that chart and also how difficult it is actually to generate alpha. And if you go back to my point about mutual funds, and now you look at hedge funds, and that simply highlights how difficult it is actually to generate alpha. Now, there are, of course, some investors that are mandated to generate alpha, right? Their goal is, they should be outperforming something, like an index, a benchmark, whatever they are. So the one area that we focus a lot of time on. That's also why our company is called Factor Research, is factor investing. And effectively, this is not what I would consider alpha. It's more like alternate beta, because alpha refers to unexplained returns, right? Like true skill or whatever you want to call it. Versus factor investing is more about other premia that you can explain from a scientific perspective, from data perspective. So that's in terms of like, if you want to like go for uncorrelated returns or excess returns, that's one approach you can do in the sense of looking at factor investing. Having said that, it's naturally also not easy. There's no free lunch. For example, you could value last 10 years hasn't performed, right? So it's also not particularly easy. Then indeed, if you do want to look at pure alpha strategies, then the only kind of things I can think of is either in very niche sectors where there's just not a lot of competition. But the problem there is that often you run into capacity issues. And so, for example, we used to trade statistical arbitrage, so quite a quantitative strategy, in real estate stocks and in MLPs, which are like master limited partnerships. And that was quite profitable. Actually, it's interesting that Laurent is based in Japan, because we traded Japanese REITs and produced so much alpha that our prime broker shut us down because we were considered too mercenary, which shows another issue, that even if you identify alpha, you might not be able to harvest it because your prime broker doesn't like what you're doing, because you're effectively fleecing other clients. So that's in terms of if you are looking for alpha seeking strategies. I think the only corner that's left is, as mentioned, esoteric places in terms of like niche sectors, strategies, just markets that aren't covered that well, that are inefficient. Then the other component, and I think this is going back to my first comment, why most investors shouldn't focus on trying to outperform the market, they simply should be focused on compounding their wealth. And that you do via asset allocation. And I think most investors get lost in picking the right stocks versus focusing on how is the portfolio constructed. And I think there's a lot of value you can add in terms of thinking about asset allocation, about risk management. And perhaps you can look at this, from a broader sense in terms of like craftsmanship or alpha more from an asset allocation perspective. So to answer your question, like in terms of general picking alpha or finding alpha strategies is very challenging. I think most would be good not to pursue that, but I would be interested in finding out what the rest of the panel thinks.
May I build on top what Nicolas said? So if I may continue. Okay, so I would say that I agree with Nicolas, so that it's very hard to obtain alpha in current markets, and it was very hard also before. So the strategies which Nicolas said, and which is he calling factor investing, or which is he calling right now beta strategies. These were the strategies which were alpha like 15 years ago. So, but right now they are so cheap and they are so easily accessible that they are not considered alpha anymore. So and the investors are looking for something new. So as he said, it's when you have a portfolio and when you build a benchmark which is very, very good build, and which is taking a look on these beta strategies, I mean value and other tilts, it's very hard to find another alpha. But I would like to build on top of what Nicolas said regarding the niche strategies. And I completely agree with Nicolas that it's very hard to find something in the place where everybody is looking at. So it means there are a lot of strategies which are built on S&P 500, but it doesn't mean that you cannot take a look behind S&P 500. So for example, when you have alpha strategy or factor strategy on S&P 500, and S&P 500, the lowest capitalization stock of S&P 500 is 2.5 billion. But when you take a look on all of the stocks which are higher than 2.5 billion in US, you will get 900 stocks, or sorry, 800 stocks. So it means there are 300 other stocks which are not in S&P 500, but have the size which is comparable to S&P 500. And there are some research papers which are saying that this space is less efficient than the space for S&P 500. Also, the same is in futures. So when you have a lot of the strategies are building, I'm talking about managed futures, about the strategies built on oil, gold, and I don't know, corn, cotton, and so on. So there are a lot of strategies like managed futures, time series momentum, carry, build on futures, and all of them are built on, I would say, 60 to 70 main futures, which are, everybody's talking about oil, everybody's about gold. But there are not the only one futures which are listed on the futures market. There are other futures which are not part of the GSCI benchmark, not part of the other benchmarks, not part of other solutions, which are, I would say, crowded. And you can take a look on them. Sometimes the liquidity is not there, so they are not so liquid. But there are others which are, I would say, liquid enough for somebody who has smaller size and can do the trades on them. And there are also research papers which are saying that Sharpe ratio on the strategies which are built on assets which are not part of the main investment universe in futures are between 50% to 100% higher. So if we have a strategy which has Sharpe ratio 0.4 on managed futures, on main managed futures, which are usually known, and you build another on the futures which are not so used, your Sharpe ratio may be higher, because you are basically trading something that the most people are not trading. And the same thing is also working in bonds. So you may trade investment grade bonds because you are allowed only to trade investment grade bonds. But one notch behind investment grade bonds are high yield bonds, which are basically nearly investment grade, but the yield is higher, efficiency is smaller, and so on. And the only reason is because the portfolio managers are not allowed to, enter this universe, because in their mandate there is that they must trade investment grade, or they must trade S&P 500, or they must trade 60 futures from, I don't know, this and this and this. And they cannot buy that 61 future which is there. So, as Nicolas said, the problem is that you cannot do it with, I don't know, hundreds of millions of euros or billions of euros. So it must be there is a capacity, and I completely agree with Nicolas. So the portfolio size must be smaller, the fees may be higher because liquidity is smaller, and so on. So it's harder to do, but it's not so efficient.
Okay, great. And Laurent, I'm sure you might have something to add here. What are your thoughts on this?
I like how Nicolas got started with he gave meaning to the whole evening with a splendid kick in the genitalia of everybody. That was good, and 100% agree with you. I mean, the average active manager gave active management a bad name. I mean, like they all show up and saying, yeah, well, we pick Apple, we do a tech fund, we pick all the A names, so we have Amazon, Alphabet, Apple. We're A-team tech fund. Thank you very much. Is that a strategy? I think a strategy is about managing risk. So a lot of these, I mean, what I've seen a lot in the hedge fund world is they don't know what they're doing. They're coming from the long world and they don't understand that it's a long short. So in my opinion, and I very much agree with you, like picking stocks on the long side, who cares? Who cares? Really? And a mutual fund manager can do that for a fraction of the cost. And an ETF will clobber both of them like a cute Canadian baby seal every year on record for every year that there is record. There's no, like 63% of active managers on the mutual fund side have underperformed their market year in, year out. And there was a cute thing like, yeah, but you need humans when things go rough. Well, no, you don't. And the proof is in the pudding. So the burden of proof has shifted from active managers. And I very strongly believe that evolution does not take prisoners. You want to survive, you need to evolve. So what we've done so far doesn't work. In fact, it has never worked. Proof is in the pudding, as Nicolas said. My belief is that the way I look at the long short game is a lot of people will disappear. What happens? I mean, we all know that investors they wait until the market tanks to allocate to the people who still perform. Those who still stand up in bear market or in difficult market, stand out, and their telephone rings off the bell, rings off the hook. Look at John Paulson, look at Einhorn, look at all these people who performed in down markets. So the real question for every person entering the long short world is you need to look at the short side, because investors, they can stomach usury fees. They can stomach the pound of flesh that you're claiming. They can stomach asthmatic returns and make even bonds look good. But whenever the market tanks, they can't. What they can't stomach is it's going down. They pay for capital protection. They pay for alpha generation when the market is down. Basically, we had a motto in my first hedge fund, like our clients pay us to go to sleep, so that they can sleep well, so they don't have to think about us. We want them not to think about us. The only time when we want them to think about us is when it's time to reallocate money. Fast forward, it became a very successful Japan hedge fund. So I very much agree with everything you say. That said, coming from the short side, I believe that it's possible to generate. Also, I have a my theory about coming from the short side. My theory about the long short space is that it suffers from an unresolved. You're gonna like this one. It suffers from an unresolved green hornet complex. So, what is the green hornet complex? Green hornet was a publisher who was running around publishing stuff, and at night he was running around with his valet, his butler Kato. That series would have been absolutely forgettable if Kato wasn't played by Bruce Lee. So the whole idea there is, in the hedge fund world, Kato is the short side. You generate money on the short side, your telephone will ring off the hook, your AUM will grow, and you'll maintain an AUM. Now, how do you do that? I believe it can be done on the equity side through it's a beta axis. The idea there is, on the long side, when everything is restated in relative terms, what happens is basically you're going long the beta in bull markets and short the beta in bear markets, and vice versa, flip around. So it changes the whole. I come from an equities perspective. It changes the whole dynamic along a beta arbitrage, and a lot of it is about position sizing, risk management, and all this. Sorry, I've hugged the mic for too long, and I want to learn from you, gentlemen.
Okay. All right. Some interesting views. And I guess a lot comes from where each of you come from. So fine, I understand that you guys focus a lot on the fact that it has to be seen at the portfolio level with risk management and things like that. So then how would you decide when you want to employ a particular strategy? I mean, what are the criteria that you're going to keep in mind? So should we go in the same order? Maybe Nicholas, you can go first.
Sure, I'm happy to do so. So, given that, like, from a background perspective, we're quants. First, if we think about like a certain strategy, we would like to start with a theory, why it might exist, okay, and then test it. And with testing, I mean backtesting it. So we're very skeptical of backtesting, but unfortunately, it's the only trade we have, or only tool we have. So we tend to do that and try to be there as scientific and as thorough as possible. So trying to go back in time as far as possible, and I don't mean like 3 years. I mean like decades, or like I don't know, however far the data goes. Trying to look at a certain strategy across markets, and not only equity markets, ideally also across asset classes. And then what often in academic papers is missed, think about transaction cost. And not just in terms of commissions, but also the cost of shorting, in terms of cost of financing, and really getting granular there. And also thinking, things like market structure might have changed. So, for example, it was fascinating that happens actually very rarely when market structure changes. But for example, if you look at the S&P 500, before I think 1970s, 1980s, before futures were introduced, it was a momentum-driven market versus today's more mean version market. So trying to backtest the strategy from how many ways there are in terms of skinning the cat. And then trying to see if the theory we had, if you can validate that or if you can't validate it. And then look at this, from an in-sample perspective, from an out-of-sample perspective, and just trying to spend as much time with it as possible. And unfortunately, if you go through this process, there's not much that's left. So you look at 100 strategies and maybe 10 look okay. After that, like pause, then you leave it for 2 weeks, don't do anything, right? Look at it again, and this reduces further. And ultimately, after a long time, usually you end up with something that's interesting, and you leave it a little bit more lying around, and then you realize, hey, this is actually not new, it's just another value strategy. So that goes back to our little bit first discussion, right? That there's very little unique strategies out there. I do think they exist, but they're very tough to find, and like you need a lot of scrubbing, and practically that's also where experience comes in. Not only like doing this stuff from a theoretical perspective, and as mentioned, most papers I find, like I read a lot of academic research, but what we often find missing is things like the practical implications. Can this be executed from a cost perspective? Are markets liquid enough? Or you're finding something that just looks great on paper, but just you could never execute. And then the second component is also what often is missing in research papers is people use tables and not charts. Now, in tables, you often see, hey, something like a strategy has, like generated 5% per annum, and you think, hey, that's great. That's completely market neutral, pure alpha generating. I love it, right? But then you kind of look at the chart, and the chart is like, like all over the place, has generating drawdowns, and you realize that although this might be great from a theoretical perspective, and you might even survive transaction costs and implementation, but the problem is you would never able to hold it because your investors would redeem if you have a 30% drawdown. So, or you yourself will lose faith in the strategy. So there's this other component that we focus a lot, and we're not chartists at all, but we like to see things, visualize them in terms of like if you think about a strategy, simply because there's this behavioral aspects of investing that are often forgotten. And it's not only you that needs to have, like whatever you found that, hey, this is truly interesting as a strategy, it's also the people who provide you with capital, because they also need to be able to go through that. And especially when it comes to alpha generating strategies in a sense of long short, there is very little patience from investors. So if you think about the average mutual fund, I think the holding period is somewhere between 2.5 and 3 years. Okay, with institutional investors, not too dissimilar. Having said that, there's a difference if you do something on the long-only side and you lose a bit of money because the market goes down. For example, talk about smart beta value strategies. There's of course a direct relationship between the value factor long short and smart beta value ETFs, right? And they underperform. But given that the market goes down, like there's not so much scrutiny by investors if your smart beta fund or ETF also goes down. There's a lot more scrutiny if you have something structured as a hedge fund strategy, market neutral, because it's truly uncorrelated to the market. And then if you have even small drawdowns of 10%, most investors don't tend to go long there. And there's like this vicious circle of, even if you found something that survives everything, then it is a great strategy for the long term, but might not be particularly implementable because like investors redeem because they have no patience in that. So to summarize that, I think in general, if you find something or think about the strategy, does it make sense? Is there a good economical theory or behavioral theory that substantiates it? Then you go through all this testing period just from a quantitative perspective. And finally, you got to think about, hey, is this actually something that I can implement and distribute as a product?
Great. Cool. Radovan?
Yes. May I continue?
Yeah, please.
I will do it the same way as before, so I will say that I completely agree with Nicolas. Okay, I will give you a few words. So I would like to move out of academic research. I'm not just a researcher, okay, so I was portfolio manager in the past and I traded a lot of money until maybe 2 years ago, and I'm only right now I'm only focused on the business. So, but I completely agree with the Nicolas in several points. The first point I would like to mention is that your strategy must be synchronized with what your client think. And if you think you do not have a client, you have a client because your boss may be a client, or your boss's boss is a client. And when they have expectations, and as Nicolas said, so you have like equity long short, and equity market is booming, and you are like going in another direction. You must explain why it is so and so on. And if it is 1 year, you can explain why you are the performing benchmark. But as Nicolas said, it usually takes around 2 to 3 years until you have. All of your clients will tell you that they are in this game for a long term, but in a short, basically to survive long term, you must survive short term. So basically, your strategy must be really synchronized with what your client is looking for. So if your client is looking for equity-like performance, and he will not be happy with the strategy which is lacking when the bull market is going, you must build strategy which is equity-like. So you cannot simply build something which is market neutral. You can have perfect strategy, but you must basically to build something which is fine with your final client. And then when you know what your client is looking for, and your client doesn't have to be your client, I mean somebody you are managing money for, but it can be your boss. So when you are okay, or when you understand what your boss is looking for, then you can start doing what Nicolas said. So basically you can start with an idea, and it must have economic sense behind. So it cannot be something that, okay, I have found this idea in the data, and it's like moving average 20 is higher than moving average 80, and I buy it on the first day on second month in October or something like that. So it must have economic reason. It must have fundamental reason why it is working, in case it's working, before you test it. So you must have a theory, and then you start testing the theory. And the trading rules are not so important. So it's not so important if you are buying, if the rule is saying something, and if the rule is like there is some change in the rule. Basically, the rule must be again synchronized with the theory. So if you are buying stocks which are trending, it doesn't matter if it's trending by momentum or by trending by a hidden macro model or by machine learning, I don't know, algorithm or whatever. So it's not so important at the end. The most important thing is that it's synchronized with that theory, and you must have a theory why that strategy should outperform, or why it should outperform. And when you have a theory and you have rules, then you will try to break them. So as Nicolas said, so you have the reason for backtesting is not because I want to see at the end the curve which is going from the lower left to higher right. Okay, on the other side. Yeah, I will do like this. Okay. So the reason for backtesting is that you want to break your strategy, and you want to see if after a backtesting you were able to basically say that, okay, I tried to break the strategy, but it still seems working. So you must basically switch. You are not trying to prove that strategy is fine. You are trying to prove that if I do anything, the strategy is still showing some alpha. And then you may hope that it will survive out of sample, because in sample and out of sample returns are exactly opposite, and you cannot basically. It's impossible.
So you should be doing the opposite then as well, no? So in sample, find the bad strategy, because out of sample would be great, no?
From my experience, it doesn't work like that. So if it's bad in sample, it's bad also out of sample. But if it's if it's fine in sample, it can work maybe out of sample. So, and I would say the last thing. So the last thing, I do not like complicated rules. So the strategy must be explainable to my mom. So I can say my mom, okay, I'm doing this and this. I'm doing it because there are other people who are doing this and this, and I think they do not do it good, and I can make money because they are doing something wasteful. So, and I must be explain it in 3 sentences, and it cannot be something like, okay, I'm building some Mercedes from this data, and we are running hundreds of tests in a second, and blah 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 blah. So in my experience, that's all.
I think you have a very smart mom.
Again?
I think you have a smart mom. Mine struggles to differentiate between stocks and bonds, and I've explained that a million times. And she worked for a bank for a number of years. So
Okay, it was. I will. Okay, it's just an example, so I will try to explain my wife probably. Maybe she will understand, but yeah. But it must be. You must be able to explain it simply.
Yeah, should be simple and robust. Yeah, agreed.
Yeah, exactly. Simple and robust. Yeah.
I explain strategy, my strategy to my 5-year-old, and to my 5-year. I mean, my 5-year-old 6 months ago, he started counting in Japanese, making addition, subtraction in Japanese. Then he was bored. He said, "Okay, I'm going to do it in English." Fine. So I taught him in English. Now I'll teach him in French. He's like, "Yeah, okay, this is boring." And now I finally started with Fibonacci series. So I explain what I do for work. And he looks at me. He's like, "We speak in Japanese at home too." Well, isn't it what everybody does? And then he goes back playing and. My son is a bit slow on the black and Scholes. He understands that actually the theta is a derivative, and he has issues with that. But, but I very much agree with you guys. As for me, I believe like whatever strategies, there are only two strategies, regardless of the asset class, regardless of the time frame. There are only two strategies. They come in two distributions. And I have a couple of pictures that I would love to share. I don't know how to do that. It's complicated. But the distribution of mean reversion and the distribution of transfer. You were done, Radovan? I'm sorry, I interrupted your train of thought. Were you done?
No. I'm okay. I said I'm fine.
I apologize if I interrupted you too soon. By the way, I mean, this is a panel, like, it's interesting. I agree with everything you say. To come back on what you said, Nicholas, I very much agree that it's a mismatch of assets and liabilities. Typically, we have investors breathing down our neck, like, hey, if you underperform another couple of months, like if you lose money for another couple of months, goodbye. So it basically trains people into taking too small profits. It doesn't mean that they don't take risk. It means that they compound risk over time. So it's like rewinding a spring. Good example was 2007 with the Quants. These guys were clocking. They thought that market neutral was capital preservation. And all of a sudden, there was my definition of crash is contagion. So there were a bunch of multi-strat who had difficulties with the CDS books, and they were forced to unwind the market neutral books, the liquid part of the assets. And then what it did is it triggered the chain reaction across the board. And I remember, like, for 2 or 3 days, we were looking at, wow, dude, the index is flat, but God, man, this is bouncing across the board. So, but the way I build strategies is I think about distribution. I think about the gain expectancy. I mean, everything I do is to improve the gain expectancy, which is a trading edge. I mean, whenever you talk to hedge fund managers, especially the discretionary side, they're like, so what's your trading edge? And here you go, Sherlock Holmes. Whereas for us, like more quantity people are like, okay, so sit down, how much time do we have? And then it's complicated. But to me, I go back into the gain expectancy, and I believe that there are two strategies. One is mean reversion, and the other one is trend following. Trend following, basically, you buy lottery tickets. It's a low win rate. It's highly volatile because, like every lottery ticket, you have below 50% win rate. So it has a built-in negative gain expectancy unless you have to kiss a lot of frogs, yeah, and to have a princess or prince, depend. But you have to be managing your losses. The second one is mean reversion. So mean reversion is you make $1, you make $1, you make $1, and you lose $10,000. Like the captain of it's a very high win rate, very low volatility, but it has a left tail, it's left skewed. So to give you an example, the captain of the Titanic had a 99% win rate. So what I do when I develop a strategy, I think in terms of gain expectancy. How can I tilt? How can I blend both? And I came upon this realization. So for me, entering a trade is not like all in, all out. You can enter, take money off the table to reduce risk if you're a short seller, and then reload, and so on, and so on and so forth, and then exit, reverse the trade. So what I'm trying to do as a short seller, I have a rule of thumb. Every time I feel intelligent, there's a short squeeze around the corner. When people start to agree with what I do, it's game over. So what I'm trying to do, the priority because when I sell, making money on the short side is riding the tail of the institutional holders. It's not about shorting a story. It's about siding. It's about spotting stocks that are being sold. They are being liquidated by institutional holders. So the way I do it is I walk in with a high probability trade, very quickly take money off the table, and then I clip coupons, and then I let my lottery ticket go. That's all I do. So I try to blend both strategies, one with a high win rate, to which I cut the left tail, and the lottery ticket to go further. So this is what I've been doing over and over and over. Now, I believe the stock market is a game. To people who believe that it's an art, like the art of short selling or whatever, go bussing tables in Hollywood, like 95% of all the starving artists. For those who believe it's a science, there's no definitive formula. I believe it's an infinite, random, complex game. Infinite in the sense that we have to stay in the game, which means we have to have a positive expectancy. Complex is like it's like Mars. Sending somebody to Mars. Putting fuel in a rocket to go to Mars, it's simple. Sending somebody to Mars, it's complicated. Sustaining life on Mars, it's complex. There's no immediate solution to that. There's no simple solution. There's no solution to it. So, and it's random in a sense that I need to very much care about my losses. And the way I look at them, I don't believe it comes in the form false positive or unavoidable. But what I can do is try and mitigate through risk management their impact over time. And it is both on the trades as they come in, as the overall portfolio heat within the portfolio. Did it make sense?
Yeah.
Yes.
And I always agree with you guys. It's a principle.
All right. So, so the next thing I have in mind, considering whatever we've spoken about, is when do you decide to say, hey, you know what, I'm done. I can't run this strategy anymore. I mean, because obviously we are going to go through these phases when there will be these drawdowns that are going to be visible on the equity curves. So then, at what stage do you say that I got to pull the plug on this strategy?
Never. No, I mean, literally, from a quant perspective, I mean, the golden rule is stick to the model. But of course, it's very difficult to do, right? If you have your investors calling you and so on. So, although that is the golden rule indeed, in terms of sticking to your model, there are, of course, times where you should rebuild the investment framework. Now, it doesn't mean fiddling with the models. It doesn't mean constantly changing your models, because that's just not healthy either, because then it's just like overfitting your system. But continue to research what you are doing, continue to see if there's any indication of structural changes, because as mentioned earlier, sometimes the market does change. So for example, if you think about decimalization in the US, right, in the sense of where stocks traded only at like 1/8 and suddenly they traded at digits, right, and spreads were a lot narrow. And so things like that. So when either that, for example, might impact like a trading strategy, or might make a trading strategy more viable from a cost perspective. Or for example, if you think about like value, for example, at the moment there's a lot of debate. Does value investing, at least when you think about it from a price to book perspective, which is the academic way of defining value, which is not perhaps my preferred way of method for value, but is what you see most products, that makes still sense when you have so many technology companies where most of the value is in intangibles. So I think in terms of like retiring a strategy, in general, you should try to avoid that as much as possible if you've been very thorough, if you've done all the things that we discussed before. And once you implement it and stick to the model also in the bad times, try to convey that as good as possible to your investors, right? And document it, but only rarely really try to change it. Because otherwise you don't have an investment framework, because you need to have some sort of framework to come up with strategies, how to implement them, and then also stick to them. And like as mentioned, only when your framework changes based on really like thorough research and time spent that something truly has is different now than before, then you should be retiring something. Having said that, there are some funds which do retire strategies constantly, which I don't understand how that works. I'd love to find out more about it. So I guess there are different perspectives on this.
Okay, I think I will continue after Nicolas. I would say That's probably the hardest question to answer. Because when you are new in quant trading, you think that, okay, the hardest question is to find working strategy. So, but in the end, you realize that, okay, that you are playing, you will find one strategy, then you will find another strategy. I will say potential strategy or potential idea. So find one potential idea, then another potential idea. Then you will find the third idea on a different market, and then another market, and then you add bonds, and then you add cryptocurrencies, and so on. And then you have a lot of ideas, and you have like multi-asset, multi-strategy fund. And the basic question is, okay, what I will do with 20 strategies which are distributed among 5 different assets, among 4 different time intervals, and what will I do if one strategy will start losing money? So what should I do? Should I leave that strategy as it is, or should I meddle with it, or so on? So it is one of the hardest questions to answer. And I would say it depends, again, it depends on the mandate you have. So I would say stick to the investment mandate you have. So if you set your clients that you will be value investor and you will build fund on value and your investment strategy is value, you will retire the strategy. Basically, you will never retire the strategy because you must stay with the investment focus. Because when you start to meddle, you start to add something. So you are a value strategy, you are a value manager, and you will add momentum, and you will add, I don't know, whatever, and you will add treasuries or anything, because you think that, okay, you are moving out of the scope of your investment mandate. You must know what your investment mandate is. So you must know what your client is expecting from you. And in this case, you will never, you can just take a look and you can think if something has changed, or if as in the case of value, as Nicola said. So if I have a value which is, for example, very easily defined as price to book, maybe I can broaden that from price to book to EBITDA to total equity value, to something other, and so on. So, but I must stay in that basically area. So I must stay, and you will never change the strategy. And then there are, when you are multi-strategy, multi-asset manager, and your mandate is to find more strategies, to have as much as you can, and to run the strategies which are profitable. Then you must have a process how to find new strategies, how to find new ideas, how to implement the ideas, and how to see if the ideas aren't already crowded, I would say. So it means, because as we said at the beginning, so most of us think that it's very hard to obtain any alpha, and I completely agree. But maybe if you do a lot of things right, and it means, for example, it means that you are diversified, you have a lot of good small ideas, and they are put into one fund, a lot of assets, a lot of time frames, and so on, so on. So you have a lot of good ideas, and they are placed into one fund. Maybe some of the ideas are not performing so well, and you may retire them because it will take some time until they will start to work again. Value is, for example, this example. So there are 2 ways how you can basically play with the strategies. You can play for a mean reversion. So you can stick and you can believe that, okay, this is a strategy and I will hold this strategy for additional 20 years because I think that at the end I will win and it will turn back. Or another way is that you will basically do the trend following on top of strategies. So you will say, okay, I believe this strategy, I think it will still work, but probably not in the next few years, or the trend is not looking well. And I will retire the strategy, I will keep that strategy, I will retire it from my portfolio, but I still have another 11 or 12 or 20 or doesn't matter. And again, it depends on the mandate. So it depends if you can do this. So if you are a multi-strategy, multi-asset fund, or if you are a value fund. If you are a value fund, you cannot retire strategy. If you are a multi-asset, multi-strategy, multi-time frame fund, you can retire strategies. And in case you can retire strategies, it makes sense to take a look on past performance. I mean, momentum on strategies as such. So it means if the strategy is working, it's performing well. It may perform well because the market is performing well, and the current setup of the market is that it helps the strategy to perform. It can be like this, or it can simply be that okay, strategy is popular and it's the strategy is because we have diverging and converging strategies, and if strategy is diverging, it means that there are other people who are also employing the strategies and they are pushing the price in the same way. Strategy is looking better and better and better and better, like momentum, for example. So it's fine to have another people joining your crowd when you are a momentum player. You can play the strategy by following the equity curve of the strategy. You can still have it, and you can cut it from your portfolio if it starts to perform bad. And when it starts to perform bad, it's hard to say. You can have some threshold based on performance or performance to risk metrics to risk metrics and so. But simply, you must be diversified. You cannot. It's hard to cut one strategy when you have 3 strategies in your fund, because you are cutting like 33% of your alphas. Okay, that's from my side.
That's actually just to the first point, Radovan, in the sense that this is one of the most difficult questions, and I agree with that, because that's being a quant investor is not very different to being a discretionary investor when it comes to believing. Because at the end of the day, we can do all the work we do, we can do all of the research, and try to be as scientific as possible. But ultimately, it still requires us to have the faith in the work we've done, and perhaps that might be like more data-based than like a discretionary investor who just likes Tesla, Tesla cars to be precise, right, or Elon Musk. But it still requires that faith, right? And everyone's being tested. So often you think, hey, or especially like younger like students and things like that, and like quant analysts, they think being a quant investor is so much easier because you have your model and it kind of like it does what it's supposed to do, right? But not really, right? And if you're overseeing that, and you have to talk to your investors about like 10% drawdown, and it requires you to basically come up with the only thing you have, which is the belief you have, right? You bring along. But a question I had for you, Laurent, is because the short side is, I guess, even more minefield than perhaps like quantitative strategies when you think about shorting certain names like Tesla, for example. How do you deal with that?
Shorting Tesla, I mean, it's like standing in. I mean, it's like first of all, the people who short Tesla, they short an idea. They don't short a stock. So, I mean, Tesla. Everybody asked me this question, like, dude, Tesla. Okay, I get it. It's an auto stock. Auto are chronic underperformers, valued as a tech, which bonds valued as junk. Something has to give, right? Yeah, I agree with that. The question is, I mean, I'll give you an analogy. Back in 2000, I think 6 or 7, I was working in a hedge fund. It makes me look like a dinosaur, which I probably am. I'm glad there's no video there. But the idea there is like shorting ideas like that. Like, for instance, Bill Ackman did that with Herbalife. Like, people don't go and short stocks. They short an idea. They short a belief. They short a story, and they get enamored with their story. I don't believe that shorting in valuation works, and I'll give you a very precise example. So back in 2005 or 6 in Japan, there was something, the consumer finance, and I remember like the valuations like were surreal. And I remember going to Lehman Brothers and seeing a whole bunch of hedge fund managers, and they were like, yeah, there was a change in law, and they were high-fiving each other, and they were outbidding each other about how much they owned of that stuff. I walked out there, like, dude, this was a big frat boy fest. And I called my boss and I said, Peter, we got to short the shit out of it. He said, why? What about the provision? No, There's a whole bunch of frat boys. They're all loaded up to their eyeballs. They're high-fiving one another. Everybody's loaded. The law's changing. That thing, everybody's into it. Fair enough. The valuation was stratospheric, and for a long period of time, it was a peaceful short. Then, a couple of years down the road, the same people, I mean, the same guy, like Simon, I met him again, and he was like, hey, dude, what about those? And he said, like, oh man, they're going bankrupt. And then there was a laundry list of 3 or 25 reasons why they would go bankrupt. The point behind those is between the time that it should implode like a rusty old Sovietic satellite in outer space, and between the time it mows the lawn, there's the whole time where it went down and the borrow was on general collateral. So shorting on a surreal valuation doesn't work. And at some point, stocks fade out of the conversation. You know, like when you talk to your brokers, or like the stale earnings estimates, the stale buy, and so on and so forth. So shorting valuation is very treacherous. Once they reach once they have escape velocity beyond the gravity of reason, they can go as much as they want. Like Tesla is a good example, for instance. Its value, it has a bigger market cap than Toyota. It doesn't make sense. So that's my take on it. And I was humbled a few times. So this is also why
Volkswagen 2008 is another famous auto stock that reached the stratosphere.
Yeah. A colleague of mine, man, I was at Fido, I was at Fidelity. A colleague of mine, like, he showed it the shit out of me, like, dude, get out! He's like, no, I'm right, double down. Like, dude, they're gonna change the rule on us. A couple of weeks down the road, they changed the rule, and I said, man, oh God, I was not happy about that one. So that was backwardation on Volkswagen. I remember that one. That was funny. So to come back to how do I retire strategies? I mean, my whole strategy toolbox is a big graveyard. But at the same time, it follows a principle. It follows a principle of evolution of how I purify. I believe that complexity is a form of laziness. And like the great Chinese philosopher Bruce Lee said, I do not trust the guy you throw 10,000 kicks one time. I like the guy, I'm afraid of the guy who throws 1,000 kick 10 times, one kick 10,000 times. So it's really about hacking into simplicity. It's about purifying the concepts in my case. And there's one concept that is interesting, is symmetry. The idea there is having the same rules on the short side and the long side. And having symmetry, why is it important? It is because if you have dyslexic rule, asymmetric rules, at some point, the long side is going to conflict with the short side. A stock could be a long, a short could be a short, and then usually it's the wrong time to ask the question. Is when performance tanks, it's when you're not happy, and so on and so forth. And this is where there's manual override. Whereas if you think in terms of symmetry, that is much harder. That's a much taller hurdle, and that cuts off a lot of bad strategies. And what I've done now, what I'm working on now, is really to come with the the second belief that I have about complexity is a form of laziness. If you have 10 or 15 strategies, you are too lazy to come back with 3 or 4 that work. End of conversation. My belief is that a lot of them can be morphed into better ones. I guess that you will probably agree with that. Like, I've seen many guys with 10, 15 strategies, but but really at the end of the day, as you said, it's like, oh, it's the same old value with a different label on it.
Yeah, correct. I mean, this is also what we find over and over again, that there's actually very few strategies which are truly diversifying, in the sense of even on the hedge fund side. So we spend a lot of time looking at different flavors like global macro, merger arbitrage, stat. I mean, don't even talk about long short equity. I think everyone knows by now that correlation to equities is a little bit too high there. But even strategies like, for example, merger arb, we looked at a while ago, and I like it theoretically. And if you calculate the correlation, like on average, it's very lowly correlated, it's constructed market neutral. But unfortunately, when markets do decline, like for example, at the beginning of this year, right, merger arb at a terrible time because mergers were canceled and spreads widen out further. So most strategies can be, like unreally truly as uncorrelated as they should be, or at least at the points when you need them to be uncorrelated. And that's something where our framework has evolved, or my own personal one, is that even most asset classes are kind of the same bet. And most of it, and I have this one slide, Vivek, if you can kindly pull it up, is the way I think about asset classes nowadays is that most is a bet on economic growth one way or the other. And what I mean with that is, if you look at equities, it depends on economic growth, because companies on average are not going to do well if it's a very ugly slide. We do this deliberately. It's supposed to create attention. And so if you think about like equities, the bet on economic growth, corporates in terms of like bonds don't do good either in a recession. Defaults go up, might not be the same time, but thereafter, private equity, venture capital, it's more or less all the same thing. It's just exposure to equity or economic growth. And so the question we try to ask more and more is, what's on the other side? What is truly diversifying? And especially if you think about the world today, like with gigantic amounts of debt, with demographics declining pretty much everywhere except in the US, and valuations in some parts of the world being quite high, the outlook for returns or even for economic growth isn't particularly peachy. So what do you do in the long term? And some of those topics, for example, demographics, is not going to hit us that badly, I mean, aside from Japan, until let's say 2050. But for example, look at China. China's going to lose 400 million people over the next 80 years. Now, 40 million people, that's approximately the population of the US. That's a good chunk. Just think about all those empty buildings, all that real estate that was invested in. I don't see rising stock markets if people are dying away on average. I mean, it's just difficult to justify. So if you think about strategies, the question we're spending more and more time on, what are kind of strategies that benefit perhaps more from economic or financial uncertainty, from volatility? And unfortunately, there's not that much out there. And most classic hedge fund strategies fail. And that's kind of an area that we find interesting to explore, but haven't found that much in a sense of strategies that are truly, to your common law, that are not the same, but truly a different flavor, and that add value to investors.
Maybe we can just have a last round of a word from each of you. Maybe we'll start with Laurent on any advice you have for aspiring quants on how do you evaluate or look for good quant strategies, even at a retail level, even apart from institutional level.
Well, it's interesting that you mentioned the retail versus the institutional, because the institutional is very much factor driven, whether it's the Pharma School of Thought, whether it's the Barra Scott. And the retail level is much more like technical analysis oriented. These days, I see a lot of guys showing up with yeah, dude, I do AI, I do machine learning. Yeah, I know you. It's the same old stuff with the bigger bazooka. See you in 2 years. I've seen generations of you. So what I would recommend for the more retail kind of person is to think of to start with templates. When you build a strategy, it's not all in, all out. It's templates, as in, for instance, okay, the template, like the Warren Buffett template, buy a shitload of it, and there's no sell button, there's no stop loss, there's no nothing. Then the next iteration is buy, sell, stop loss. Then the next iteration is buy, scale in, scale out, and so on and so forth. So think in terms of templates. Look at the gain expectancy. And if there's one thing I do know is something that Reversion alluded to, is infanticide is a healthy sport on the quantitative side. Go out and kill your babies. I mean, I'm a short seller, and I always have this quote that I love. This is from The Martian. This is space. The environment doesn't cooperate. Yes, I ate a lot of shit. So on to you guys.
Nicholas, would you like?
Sure. So I think most retail investors should, as I mentioned earlier, completely ignore all sorts of algorithmic quantitative strategies, or at least 95% of their capital invest in low-cost diversified ETFs. Think about risk management. That's actually one thing where I think, even from a retail perspective, you can achieve much with very little, even super simple systems. We're big believers of risk management, simply because I spent enough times in Europe, living in Japan, where I saw capital markets that do not go up all the time, and combine that with behavioral biases. I think that's an important part, in a sense of just trying to figure out your own system. should be simple and robust, but understand it, should be backed by research, and then you can consider implementing that. But that's about, I think, the only advice I would have for retail investors. And in general, be skeptical and cautious of anything that looks too good to be true.
Yeah, good advice. And Radovan, what about you?
Okay, so I will just be very quick. So basically, there are just one question that investor must to answer to himself. So I want to do it for full time, and I want to become a professional, or I want to have it as a hobby. If you want to have it as a hobby, buy ETFs. Okay, so because basically it's very efficient. Markets are very, very efficient, and if you would like to be investment professional, so become a part of some company or anything, it doesn't have to be manage your own money. You can manage money by being employer, so being employee, so working for somebody. Then I would use the sports analogy. So I have a friend of mine, and he always said that, okay, when you are going to trade money in the market, it's like playing a soccer or European football. So you can start and go playing against Messi or against Barcelona. It's like, and it's the same if you try to build system on Euro USD currency pair, or building a system on S&P 500 stocks. So it's the same if I go and play with the Messi. So I will end up with 10 goals or 20 goals, and I will give 0. So it means it's extremely efficient. But you can try to go and play the 5th league. So I would say a small village against another village. And when you play the soccer, the one village against another village, you can be the best player on the field in that village competition. And it means in that village competition, in the markets which are, I would say, not very efficient, which are out of the scope of professional investors, there is the possibility that you can obtain some performance. But if you try to compete against S&P 500 or I don't know anything which the institutions are looking at, basically it's better to buy ETF. so that would be my advice. So do not try to play Premier League or something like that. So try to play village against the village.
Yeah, that's good advice. That's very good advice.
One of the questions is for you, I guess. In fact, any one of you can pick it up. So Rishabh says, I'm a student and I want to build an algorithm for beating the S&P 500. What are the things that you would recommend me to look for beyond what a research paper says to look at?
The question is for who?
I guess anyone can pick it. It's about what should you look for in a paper. I think that's the question. If you were to look through some academic studies,
it's more new camp, brother Van, no?
Okay, so I would say, do not use academic research as sacred, sacred paper. So what is written there, it must be truth. So use the academic paper as inspiration. So that's what we are trying to tell our clients, and what we are, how I am using also the Quantitative. So take a look on this paper, think about it, try to understand what is fundamental reason why the strategy is working, and if you understand what is the economic reason behind, maybe you can try to move further. It means, so try to find another asset class, try to find some smaller stocks, try to find some idea which is not written in that academic paper, but is based on that fundamental idea, and maybe you will be able to find something which is not mainstream. And if you find something which is not the mainstream, it's better because you will not be so correlated, your strategy will be more unique, and so on. So you will get a lot by not taking academic papers as a secret, but taking them as an inspiration. So think about it, and so on. And that would be the best. Try to find that distill that idea, and as my colleague said, so try to simplify, try to find that the best version of that idea, and to use it maybe on some other asset class and so on, other investment universes, smaller stocks and so on. Somewhere there is no competition.
And I think we'll take the last question. There are a few people who've asked about what do you guys think about technical analysis? I mean as a style of analysis.
Yeah, correct. So I mean, technical analysis has been around for a long time, right? Like you can go back to hundreds of years where Japanese investors have been pursuing that. And the funny thing is, if you look at it from a institutional perspective, either like in the States or in Europe, there are few people who still publish technical analysis. Broadly speaking, it's supported. Having said that, you can say that there are parallels between technical analysis and quantitative investing, right? Because both often is looking at charts and patterns. The only difference is, in terms of from a quantitative perspective, it's it's more scientific, it's more objective in the sense of trying code that, versus technical analysis in terms of from looking at it from an eye perspective, very discretionary. So I think if you look at it from an academic perspective, there's not a lot of support for it. So in general, I would be very cautious on that. Although I do acknowledge that it's still widely followed, and there are lots of fans of people doing that.
I have an answer about that. So let me ask you guys, if I say, what is the construction, what is the building, what is the thing that you can see from the face of the moon? What would you think? Most people would say the Great Chinese Wall. Now, this was said by an English explorer who'd never been to China back in the 18th century. So when the dominant mode of transportation was horse cart. There's a lot of foresight. Besides, the people who went to the moon, there was only a limited sample, fewer than 10, none of whom said they saw the Great Chinese Wall. So technical analysis, as it is, has been there for a long time. Fibonacci and so on and so forth has been there for a long time, but it is unproven, untested, simply untested. So these are convictions and belief, and a lot of it doesn't work. And my friend Michael Covell was saying the other day, the predictive technical analysis has zero form of validity. There's very little money allocated to that. On the other hand, the asset class that Radovan was talking about earlier on, the CTAs, these guys are trend followers, so they hop on the trend. These are reactive technical analysis in a way, and much more robust and quantitative. These guys are doing well. So I would do away with all the RSI, MACD, yada yada. This is folklore. This is keep it for Christmas. These are great Christmas garlands and nothing further. Keep it simple, really. The whole idea behind this is that the false positive, when it works, it does work, but when it doesn't work, these creates false positive that tend to erode the equity curve. And that's it. That was my point behind it eventually.
All right, this was great, guys. So on behalf of QI and all of our viewers and people who will probably see the recordings, thank you so much for your time and for all the insights you shared on these subjects. So before I let you guys off, if people are looking for you or they want to find your work, where can they find you? I mean, we can share it in the show notes and stuff that we put out on social media, but if you just want to say it, where can they look for you? Like maybe Twitter handles or anything?
Yeah, Twitter handle @FactorResearch, our website. You can subscribe to our research for free, or patch me on LinkedIn.
Okay, great.
Yeah, basically the same. So our website, Twitter, LinkedIn, Facebook page. That's it.
Okay. So that's Quant.
Yes.
Great.
I'm on Quora. I'm on Quora and LinkedIn mostly. So Quora answer a lot of questions in a colorful way, and LinkedIn.
Okay, great. So thanks, guys. All right, take care. Good evening, good night. Good night to Laurent, and have a good evening, the two of you, Radovan and Nick.
Yeah, thank
Thanks.
you.
Bye, guys.
Thank
Bye
you.
bye, bye
All
guys.
right. All right.
Bye-bye.
See you. Bye bye. Thank you.